Welcome to our guide on understanding Forex prices. In the dynamic world of Forex trading, prices are constantly changing, driven by a multitude of factors. Firstly, let's study price in a little bit more detail. This stuff is for the newbies. Please skip this video if you think you know. So what is price? Price is a value given to a particular instrument, usually in monetary terms, and its value is dependent on supply and demand. Let's break it down in a way that's easy to understand. Imagine you're at a huge party and there's this super popular snack that everyone's craving. Let's say it's pizza. Now, when there's a massive pizza shortage and everyone's desperate to get a slice, what happens? You guessed it. Prices shoot through the roof faster than you can say, "Extra cheese, please." Those spots on your price charts where everyone's clamoring for pizza, we call those demand zones, and they're like the VIP section of the party. That's where all the hungry buyers gather, prepared to spend money to satisfy their cravings. And as they keep buying, prices soar higher and higher, like fireworks on the 4th of July. But hold on to your hats, because there's a flip side to this pizza party. What if, by some miracle, there's suddenly way too much pizza and not enough hungry folks to gobble it all up? Well, in that case, the sellers start to panic. They're practically begging people to take a slice off their hands, so they slash prices faster than you can say discount deal. Those supply zones on your charts, think of them as the pizza no one wants. They're like the sad leftovers nobody's interested in. Sellers hang around there hoping against hope to find someone willing to take those unwanted slices off their hands. But with so few takers, prices plummet faster than a pizza delivery guy racing against the clock. So whether you're trading pizzas or stocks, just remember, it's all about keeping an eye on those supply and demand zones. Because in the wild world of trading, knowing when to buy low and sell high is the key to scoring big and staying ahead of the game. Like we earlier said, when you see the market on the rise, what do you think is happening behind the scenes? Well, it's a clear sign that demand is high for that particular instrument. On the flip side, if things are heading south, it's a telltale sign that demand has dwindled and there's an abundance of supply floating around. But here's the kicker. Price isn't set in stone. It's a bit like a roller coaster ride, constantly shifting and changing over time. That means what you see today might not be what you get tomorrow, next month, or even next year. It's the ebb and flow of supply and demand over time that sends prices soaring to new heights or plunging to new lows. So, the next time you're analyzing your charts, remember to keep a close eye on the ever-changing dance between supply and demand, because understanding how these forces play out over time is the key to unlocking the secrets of the trading universe. All right, imagine you're a detective trying to crack the case of constantly changing prices. Your key evidence, tiny little bars on a chart. These aren't your average bar charts, though. These are price bars, candlesticks, or even line charts. Why are these charts so important? Because they're like a visual timeline of price changes. Each bar or line segment shows you the price of something at a specific time. The cooler part. By looking at a bunch of these bars together, you can start to see a story unfold. A story of a battle between people selling otherwise known as supply and people buying otherwise known as demand. The way the bars are arranged, how high and low they go, can tell you if there were more sellers than buyers at that time driving the price down, vice versa. These areas of high or low buying and selling activity become like battlegrounds on the chart, and by studying them, you can start to understand the forces driving the price up and down over minutes, days, even months. Pretty neat, huh? Geopolitical events, such as elections, trade agreements, and geopolitical tensions can also significantly impact Forex prices as they affect investor confidence and risk appetite. Central bank policies, including interest rate decisions and monetary policy statements, play a crucial role in shaping Forex prices. Traders closely monitor central bank announcements for signals about future economic conditions. Market sentiment, or the overall attitude of traders towards a currency pair, can cause prices to fluctuate rapidly. Factors such as fear, greed, and market speculation can drive short-term price movements. In addition to fundamental analysis, traders also use technical analysis to predict future price movements based on historical price data and chart patterns. Ultimately, understanding Forex prices requires a combination of fundamental and technical analysis, along with a keen awareness of market dynamics and global events. In Forex, there are basically three popular types of Forex charts. 1. The bar chart. 2. Candlestick charts. And lastly, line charts. First up, let's talk about bar charts. The bar chart looks like a stick or bar with two short knobs on both sides. The knob on the left is the opening price, and the knob on the right is the closing price. Then there's the wick on the upper end and the lower end. The highest point or level of the wick on the upper end is the highest price that was reached during a certain time frame or period, and the lowest point of the lower wick is the lowest price that was reached also during the same time frame or period. Bar charts are great for quickly identifying trends and key price levels. Traders often use them to spot support and resistance levels, as well as to assess market volatility. Now, let's move on to candlestick charts. Candlestick charts originated in Japan and have become immensely popular among traders worldwide. Similar to bar charts, each candlestick represents a specific time frame. However, candlestick charts provide additional information about price movements within that period. A candlestick consists of a body and two wicks, also known as shadows. The body represents the opening and closing prices for the period, with different colors indicating whether the price moved up or down. The wicks, on the other hand, show the highest and lowest prices reached during the period. The only difference between the bar chart and the candlestick chart is that the candlestick chart has a body and the bar chart does not. The red color is most often used to indicate a bearish candlestick, which means the price opened up high and closed lower. A green candlestick represents a bullish candlestick and is the exact opposite. Lastly, let's discuss line charts. Line charts are the simplest of the three chart types, as they only plot the closing prices for each period and connect them with a line. Line charts are useful for identifying long-term trends and visualizing overall price movement over time. While they may lack the detail of bar and candlestick charts, they offer a clear and concise view of price direction. In summary, bar charts, candlestick charts, and line charts each offer unique insights into price movements and are valuable tools for traders and investors alike. Whether you're analyzing short-term fluctuations or long-term trends, understanding these chart types is essential for navigating the financial markets with confidence. That's all for today's video. We hope you found it informative and that you now have a better understanding of price movements, bar, candlestick, and line charts. If you enjoyed this video, don't forget to like, share, and subscribe for more content. Thanks for watching, and we'll see you in the next one.